Welcome everyone to another of our weekly investment manager videos, and many thanks once again for tuning in. For the first time in a number of years, UK large cap equities are becoming one of the most preferred global allocations. So is now the time to revisit UK equity income funds? Well, who better to ask this and other questions than Colin Morton, manager of the Franklin Templeton UK Equity Income Fund and the UK Rising Dividend Fund. And some say the best thing to come out of Leeds after Leeds United. And who am I to argue? But first, before we get into this content, if you are enjoying the channel, it would be wonderful if you could subscribe. It really does assist us genuinely in delivering our financial planning and investment content to a wider audience, and you would be helping us all out. So, onto the content, and many thanks for your time once again, Colin.
No trouble at all.
Kicking off, is 2021 the renaissance year for UK equity income?
Well, let's hope so. I think, but the honest answer is there's some really good opportunities out there in the UK. And I mean, I think, as we all know, 2020, or the majority of it, was an incredibly tough year.
Yeah.
And a lot of traditional UK equity income stocks tend to be quite exposed to what's happening with the global economy and the UK economy.
Mm-hmm.
And obviously, when we went through the COVID situation with lots of businesses closing completely, so lots of businesses doing absolutely, nothing at all, it was pretty horrific for a lot of these companies. They were having to reduce the dividends or completely cut their dividends because they didn't have the cash flow to pay it.
Mm-hmm.
So again, certainly in my relatively long experience of running income, one of the toughest periods we've ever seen for UK equity income stocks. However, hopefully with the vaccine now, continuing to accelerate, and the UK haven't done such a great job on that, but also we're seeing big improvements in other parts of the world, the US, a lot of Europe now. So if the vaccine can continue to prove as successful as it has so far,
mm-hmm.
and we can continue to see that rolled out globally, we can start to hopefully see a return to normal. Mm-hmm. And that's what the stock market started to already predict. So if you look at the market since last November, we've had this very large rally in the stock market since the vaccine news came out. And a lot of these companies which are exposed to global economies and the UK economy, there's a lot more optimism around them now, because if we're going to get back to a bit more normal times where people are going out again and doing things that they want to do, these businesses are going to start generating profits again and cash flows, and will start paying dividends again. And we're already seeing that. I mean, the encouraging news is, after last year's really tough year, we've already seen a number of companies start to, who didn't pay dividends last year, are now paying dividends, and companies who cut the dividend last year are resuming on sort of a small growth of their dividends this year. So there's some really encouraging signs ahead for UK equity income stocks. But of course, I don't want to put a sort of damper on this, but a lot of that does obviously depend on how things develop over the next 6-12 months with the news on the pandemic.
Yeah, and obviously we'll need to keep a close eye on that. The other interesting aspect for income investors is rising inflation and steepening bond yields. Now focusing upon your rising dividend fund, what can that bring to the table for income investors?
Well, to be honest with you, I sort of welcome a little bit of each. So what I mean by that is inflation being zero, and as it got to almost through the pandemic, is sort of not good news for very many people, because obviously businesses are really struggling. There's no price increases at all. Mm-hmm. So, I mean, we get into the worries about deflation then, and obviously all the potential disasters that can bring. So none of us want inflation in the old sense of the word, of huge high numbers of inflation. But if we could get back to where the target range is with the Bank of England, which obviously is a couple of percent inflation, that generally is quite good news for companies, because it enables them to have some element of price increases to help their business along going forward. Similar, bond yields at zero is obviously is a bit worrying, because what is that telling investors? What is the message? And obviously in that type of world, we're suggesting a world of very little growth, no inflation, and really, to be honest, a pretty difficult outlook for global economy. So if we could start to see bond yields again normalizing a little bit. Now, by that again, I don't mean none of us want 10-year bond yields to head back up to 10% again, as they were, 20 years ago, with obviously mortgages and everything linked to them. But if we started to see bond yields heading back towards a couple of percent again, which is where they were a few years ago,
Yeah.
I think that's sort of to be welcomed. And the Rising Dividend Fund is very well positioned in that area because, first of all, we're already yielding more than bond yields anyway.
Mm-hmm.
So we're already giving you a very significant premium over the current yield for bonds. And of course, if we start to see a bit of inflation and a bit of growth coming back into the economy as well, a small amount of inflation and a bit of growth as we recover from the pandemic, that should mean that we get better dividend growth as well.
Mm-hmm.
So we're in a nice position for the Rising Dividend Fund, and to be honest, for the Equity Income Fund as well, where we're already giving you a starting yield above that you can get on bonds, with the potential to give you dividend growth as well. And as we know with bonds, you're not going to get any growth. You're just going to get whatever you fix into today. That's going to be your level of income for however long you decide to fix into it. So again, as long as we have a bit of inflation, but not ridiculously high inflation, and as long as we see bond yields rising a little bit from these really depressed levels, I don't see that as a headwind for UK equity income or rising dividends at all.
All right, that's really good to hear, and certainly a bit of a relief for those investors who've really been struggling to find income over recent years. Drilling down into the funds, how are you positioned currently, and are there any particular opportunities that are catching your eye at this moment in time?
We're running what I always describe as very sensible, balanced portfolios. So what I mean by that is within both portfolios, we've still got exposure to those, what I describe as reliable compound type companies, which did such a great job for us over the last 10 years or more, and also did a very good job for us in the first 3 or 6 months of the pandemic, because these were the companies which could still deliver, because a lot of the products that they're selling are sort of necessities, and so they were able to still do okay and continue to pay the dividend, and in some cases increase the dividend. The names that include in there would be companies like Unilever, AstraZeneca, these sort of businesses which are very reliable, very solid, and they did exactly what we wanted them to do. We've been mixing that within the portfolio with companies which have been more impacted by the downturn. So shares where really struggled last year because of the pandemic, where in a normalized year, they would look really attractive. So they're the sort of companies that we've also been either adding to or bringing into the portfolio. So companies like Next in retail, and they've done very well for us recently. We were adding to that sort of position. As you can imagine, they had a very tough first 6 months of last year, but things have improved for them as things have opened up. So we've been buying things like that. We've also been looking at some of the financial names, which had a very tough time when equity markets went down and global asset markets fell dramatically. So we were adding and looking at new positions in things like, Schroders and these sort of companies as well. So we're trying to run these balanced, sensible portfolios, because we for the long term, we want those long-term compound businesses which give us good levels of dividend and growing dividend. But at the same time, we don't want to miss out on those opportunities that have been created because of the pandemic. So we've been trying to be very selective in our opportunities and look for those ideas as they come along. I must admit, we were much more active last year when the market had lots of volatility in the stock market, went down all the way to 5,000, the FTSE 100 in the spring, and lots of stocks got hit very hard, and we were looking at those. This last few months, we've been a lot quiet in terms of new activity within the portfolio, because we feel like we're on a bit more of an even keel now. The market's recovered strongly. A lot of that obvious undervaluation of some of those stocks has gone now. There's still selective opportunities out there, but again, we are now watching, as we said earlier, and we're now watching very closely the developments really on what's happening with the pandemic and what's happened with the vaccination program.
Yeah, absolutely. I think the comment for today would be cautiously optimistic, and certainly from my perspective, looking at equity income funds for the first time in a long time, I think investors are going to be quite positive on what you've been able to say today. Colin, it's once again, it's magic to see you. Glad that you're doing so well. You take care, and I'm sure we'll catch up soon.
Thank you very much. Thank you.